This whole place is a mess. Apparently someone who's been living and working in the same spot for like 4 months. What's up, guys? It's Monty Mike and welcome to Rockstar News. So one of the big questions when it comes to buying a house right now in this market is it even possible? You know, one of the things that we're starting to see is that a lot of banks are starting to increase the qualifications that are needed in order to purchase a house. You know, before, essentially you can have between like a 680 credit score below, not all the way down to like 500s, but you used to have a lower score in order to buy a house, and now they're increasing it all the way to 700. And then before that, in particular, I'm speaking about Chase is now requiring you to put down 20% for your home loan. This is even including FHA and VA loans as well. So they're changing the guidelines because of what's going on right now. They're being very, very skittish when it comes to lending money to potential buyers because of essentially the job market. You know, a lot of people are losing their jobs right now. Unemployment's at 13%. It was a little bit higher, but once the lockdowns lifted up, people were able to go back to work for the most part. But this week alone, we saw about 1.3 million people lose their jobs, and we're probably going to see a lot more people as a lot of businesses essentially can't, cope with the lockdown and the losses that they take. So, in order to get you guys the best information and the best answers about what's going on in the marketplace, I sat down with Evan Batista from the mortgage firm in order to get a clear idea about what's happening, where we're going, and what's going to go down. So stay tuned and check that interview out. Hey, what's up, Evan? Appreciate you coming on the show and talking with us today. Kind of want to get your opinion and just to see like what's going on in the marketplace as far as when it comes to home buyers, trying to figure out what's the next step or what is actually happening right now. You know, there's a lot of information that's being thrown out there, but it doesn't seem like anybody has a clear idea about what is going on when it comes to mortgages, when it comes to the home buying process. Recently just read an article talking about how Chase is increasing their, the credit scores up to 700. They're also requiring you to put 20% down on, I guess that's conventional loans. I guess that's not also factoring in FHAs, unless it does. I don't know. So what is happening right now when it comes to getting a mortgage?
So right now, lenders are seeing what's going on with the market as far as COVID-19 and how that's affecting employment. And basically, when employment gets affected, then there's a higher risk or possibility that people might default on their loan. So what they're doing is they're bumping up the requirements in order to kind of protect and shield themselves from possible risk and damages that might happen down the line. So if you lose your job today, you're not going to lose your home tomorrow. So what they're doing is it's going to take a couple months. So what they're doing is they're kind of raising the bar for anybody new coming in, especially with the whole deferment of payments and everything like that. They're kind of just making it a little bit more stringent and being more particular on who they lend money to, just to protect themselves and shield themselves.
Okay, I mean, so is this just for the conventional loans, or is this also applying to FHA loans or VA loans?
This is also to FHA loan across the board. I've seen most lenders bump up their requirements from 530 or 580 credit score for FHA up to 620, 640, 660. So across the board, whether it's VA, FHA, I've definitely seen lenders tighten up on guidelines. And one thing that I'm really seeing is the verification of employment. Normally throughout the process, we do it one time, usually maybe 2 weeks before closing, and then that suffices. Now we're doing one in the middle of the process, one a week before, and then one the day of. So they want to make sure that your hours haven't been cut. They want to make sure that you're still employed in the same manner, and make sure that you're going to make good on this loan.
Yeah, I wasn't aware that the banks themselves, the individual lenders, the private organizations could actually change the requirements when it comes to FHA and VA loans. Is that something that's always been the case, or I'm missing something here?
So Fannie Mae, FHA, Freddie Mac, they all have what they're willing to buy on the second market. So they back these loans, and they have requirements. So as a lender, those are the minimum requirements that you have to follow. But lenders have overlaying guidelines. So basically, FHA says we can do a FHA loan down to 500, 530, but most lenders won't go that low because of the risk factor. So they'll say, hey, like Chase did, it's only 700 for conventional, or other lenders, hey, we're lending at 620 for FHA. So in order for that to qualify and be backed by Fannie, Freddie, or FHA, they have to meet certain requirements, but they're not held to have those requirements. They just have to be above. So what lenders are doing is they're just going ahead and protecting themselves and pretty much just kind of raising these standards.
Gotcha. Okay. So, I mean, because of these new policies that are kicking out because of the whole COVID-19 and the risk of, people potentially losing their jobs, has this affected people negatively when it comes to like lower income? Like, essentially lower income people who are using FHA loans, are they now putting everything on the back burner just because let's be real, like, I think I was reading a report that was saying that lower income people who essentially, in the service industry are more likely to lose their job because of COVID-19 than someone who's in like a white collar job. So is it disproportionately affecting those people more?
I honestly won't say that the lower wage earners are being affected more, at least in my personal opinion. I think everyone's being affected across the board, whether you're a manager, assistant manager. Maybe once you get up to like the main board members and higher management, maybe those are not affected. But I don't think COVID is really discriminating against anybody. If you're in the service industry, for sure, you're not, you're definitely being affected, but across the board. Because if your business, whatever your business is, it's being affected because they're closing it. They're putting limitations, restrictions, how many people can come in. So every business is being affected to a different degree. So I think if you're in upper management, I mean, you might not be as affected, but they're still being affected. Hours are still being cut. I took an application on a young lady who is a manager at a gym, and even though she's salaried, she's only getting paid 15 hours a week, even though she's
Yeah.
supposed to be getting paid salary. So across the board, doesn't matter if you're high on the totem pole or on the bottom, you're being affected one way or another.
Gotcha. Okay. So what about HELOCs? There was a couple of reports I was reading that they were kind of like like a lot of banks were essentially stepping away from HELOCs, getting away from credit lines of credit. What's going on in that market?
So as far as HELOCs and home line equities and personal lines, basically it's once again they're trying to shield themselves from any possible risk, and they don't want, being that the uncertainty of when this is going to be over, lenders don't know. So the last thing they want to do is extend credit and not know whether they're going to get paid in 90 days, 120, 180 days, or possibly even default and just have a negative debt on their books and just holding that weight. So that's pretty much why they stopped doing home equity lines of credit. If you can get one, I would definitely go ahead and get one. Always in a downturn economy is when most millionaires are made. So if you can
Hmm.
capitalize on this opportunity, I would definitely, whether it be do a refi, take cash out, invest, the stock market, real estate, or whatever the case might be, I would do it. But lenders are definitely tightening up on the HELOCs and the lines of credit.
Gotcha. Now, is this affecting refinancing as well?
So it is affecting refinances in the standpoint from employment, right? If you've been furloughed, we can't do the refinance. If your hours have been cut, even if you qualify with that cut income, we still won't be able to do it. The reason behind it is if you went from working 40 hours to working 20 hours, the underwriter's looking at it like, if you went down to 20 hours, well, what's not to say that you're not going to have a job next month, so that's how they're looking at it. So refinances and the verifications of employment have increased. They've gotten tighter, and but people are still getting loans. This I don't want to paint it as a grim picture, but this is just kind of what's going on. But people are still doing loans. Interest rates are at an all-time low. Actually, business has increased since
Mhm.
all of this has occurred. So refinance business is doing really well right now. Interest rates are ridiculous.
Wait,
Um,
yeah.
yeah,
Speaking of the interest rate, where's that at right now?
All right. So normally when I'm not quoting anything, so I'm just letting you know kind of
Legalese, yes, we understand.
where we are in general. I'm seeing people in the high twos,
The high
like
twos.
high twos, like 2.75,
Woo!
2.875, and they don't have the best credit. This is FHA, of course.
Ooh, you talk about okay, so FHA loan, not the best credit. They're getting almost the high twos in credit as far as our credit interest rate.
So I just priced somebody out at a 690 credit score, and it was 2.875, and it wasn't charging them anything. It's just it's
Oh
amazing right now.
boy. Well, it's like right now the Fed is pumping out that cash, they're over here making a shower. So yeah, that interest rate is being pushed down, but the problem is that like is that going to create another 2008?
All right, so in my opinion, what they're trying to stop and kind of prolong is the inevitable. In my opinion, real estate is pretty much at its peak as far as where we were in 2007, 2008, as far as prices in Orlando. If you look up what the house value is now and where it was 2008, they're pretty much the same. So with the economy starting to slow down, and COVID-19 hitting, and real estate being where it's at, I think that they don't want everything to crash at the same time, so they're artificially pumping money into the economy in order for real estate not to collapse. Because if real estate collapse, I mean, unemployment, I think last time I checked was like 13% or something.
Mm-hmm.
Um, if we have massive foreclosures, and then real estate prices start going down, it's just kind of a trickle effect, and it just turns into a big snowball. So what I think they're doing is they're just kind of pumping the brakes and just waiting for what's going on to kind of subside, and then everything will go back to normal. And what they're doing is they're artificially lowering interest rates in order to keep real estate from crashing. And that's my opinion, of course. Nobody has the crystal ball to kind of know what's going to happen, but
Yeah.
usually it's every 10 years you see kind of the wave go up and down. So we haven't had uh, a reset since 2008, and we're overdue. We're 2 years overdue. So
Yeah, that business cycle will get you every time. And see, and that's the thing that I'm concerned about is whenever the Federal Reserve decides to pump cash, at cheap interest rates into the market, and I know we're getting off topic here, but that's where the money flows is where the next bubble gets filled up. That's the air that gets pumped into that market.
right.
And so right now, like you said, they're trying to prop up real estate. People don't realize this, but the real estate market is the largest industry in the world, not just in America. Like you got to think about all the people who are involved in it, from not just real estate agents or mortgage guys, but you got carpenters, you got plumbers, you got electricians, you got roofers, you got developers, you got painters, you got everybody who's involved in real estate. And I understand that because it's the largest market or industry in the world that they're trying to keep that alive. But then that's what creates the next bubble where you get a bunch of people who are getting into houses at low, cheap, super, low interest rates. And then when that interest rate starts to rise, I guess the saving grace here is that, unless I don't know this, they're not really pushing adjustable rate mortgages like they used to, are they?
No, the adjustable rate mortgages are definitely not being pushed, and there's a lot of regulation when it comes to that. I usually don't offer that to clients unless they're investors. I know that they're going to live in the property maybe 3 or 5 years and get rid of it, because the pricing on it is you don't get that big of a break as you did before.
Yeah.
Um, so right now, my biggest concern with what's going on with real estate is the possibility of properties going down in value, and then people foreclosing or being upside down. That's kind of what, if you had to ask me what am I worried about real estate, I mean it can only go up so much before it's gotta normalize or be reset. So
Yeah.
when that reset is, I actually thought this was gonna happen last year, but I was wrong. So I mean, we might not see something for another year, 2 years, or it might happen soon. So like I said, nobody has that crystal ball.
Well, I mean, I think because it's that business cycle that everybody's kind of been predicting that every 10 years we go on
Right.
this this swing down. We go into like a bit of recession because it's a misallocation of resources and the market is kind of correcting itself. But the problem is that like it was kind of a self-fulfilling prophecy in 2019 where everybody was like, oh, we're coming up on the 10 years. Like, what are we going to do? Like, what's going to happen? Um, and I don't think no one in the, if you would have gave someone $1 million to guess that COVID-19 was going to happen in 2020, no one would have got it correct,
At
but
all.
everybody was predicting that we're going to see a slowdown in the market. And it was mainly because we're seeing home prices essentially climb faster than what the average wage was climbing. But then if you look at the affordability index, it's like above 100. So like what's going on with essentially that, like what is going on with the affordability index, what is going on with essentially I know you're not an economist and I'm not trying to sit here and say, hey, what's going on with deployment, but as far as like from a mortgage standpoint, have you seen it become more difficult for people?
Because the prices of homes and real estate has gone up, qualifying is a lot harder. A couple years ago, $150,000 home would be something decent in Central Florida.
How long ago were you
$150,000 now. Even 4 or 5 years ago, like even 5 years ago, $150,000 will get you something nice. You could get a fix and flip in Winter Park for 150,000. Now you can't even step foot in Winter
You
Park.
talk about on the east side of 436, right?
Right around there,
Yeah.
which is still considered Winter Park. But my point being is you can't buy anything in Winter Park.
Yeah.
You can't buy anything in East Side Orlando for 150. It's just not happening. Not a single family residence. Condos that were uh $40,000 and $50,000 are now going for $100,000, 120. So it makes affording a property a lot more difficult when prices on real estate have gone up, making your monthly mortgage a lot higher, where a couple years ago it wouldn't have been an issue. And quite frankly, the wages in Florida haven't gone up that much, at least in our area. I mean, it's pretty much wages have gone up maybe 3% every single year, but real estate is jumping up what 5-7% every single year.
Yeah.
And you're lucky if you get a 3% raise, like if you're working at your same job. So
yeah, no, I agree with you. I think most people are not getting raises at all, and it depends on the industry that they're working in.
right.
Like, and I think the problem with such a Florida is that we're such a service heavy industry. Most people are in here are working for basically the mouse, and the mouse isn't writing a contract with guarantee pay increases every year. So
Right.
but that's not to say there isn't tech jobs or there isn't STEM jobs that are coming into Central Florida. It's just the biggest providers are these service industries, and they tend to typically be much lower on wages. Yeah. So as far as now that we kind of got that out the way, what is the best possible way for a home buyer, first time home buyer, to proceed forward?
So the best way to proceed forward would really just to go ahead and actually just get the process started and get qualified. Like that's
So
kind of
there's
what I
nothing special they have to do as far as COVID-19, like as far as like CDC guidelines.
we can do Zoom meetings and Zoom applications. We can
Mhm.
do one over the phone. I mean, if you want to come in the office, we can just stay 6 feet apart. But
Yeah, you stay there, I'll
I,
stay here.
yeah, exactly. So I always recommend people to go ahead and get the process started. It's kind of like when you go to the doctors, right? Nobody wants to go to the doctors because they know something is wrong, right? Nobody wants to speak to the mortgage, the loan officer, because they know that they got work to do, whether it be credit or they may not be ready. But the longer you prolong it, is just the longer, the real estate keeps going up. It just becomes harder and harder to purchase. So
Yeah.
you definitely want to see what you need to do and what you need to start fixing, because if you want to get a summer body, you don't start working on it in the summer. You start working on it in the winter. So
Mhm.
if you're trying to buy a house in 6 or 9 or 12 months, you definitely want to start working on it now, so we have time to make any adjustments and you know what you have to do. The last thing you want to do is have 3 months, 6 months to move out, and then you see that something's on your credit that's not supposed to be there. you
Yeah.
know, or that you need to increase your credit score, or now we need more money than you thought you needed because you didn't know how the process went.
Well, I mean, that's going to be the case. A lot of lenders are going to start going towards the 20% down, and you're going to need a lot more money in order to do that. And 20% on a $200,000 house, you may not be
40
able to
grand.
float that. Yeah, so it's 40 grand, and that's not even including closing costs that's involved.
Right.
So speaking of closing costs, so is the mortgage firm, the company you're with, are they requiring 20% down as well?
No, not at all. We're still doing 3% down conventional and three and a
You guys
half
are like, we
percent.
don't care.
I mean, we're still for the people, and definitely trying to help people build wealth through home ownership. So we have other companies that we work with that they lend money, and we also have a private line that we lend from. So we're able to still stay afloat and not have to charge 20% down to actually make a loan happen.
Mhm. Gotcha. Now, as far as closing costs go, because this is something that like most like first time home buyers kind of get surprised by how much money they actually bring to the table just to pay for fees. Now, not trying to get you to speak for the entire industry or even name numbers for yourself exactly, but what is something that most home buyers should be prepared to pay, like the average?
So the average up to $300,000, the average closing costs are right around 7,500. What a lot of people don't realize is that a good chunk of this is going back to you because we have to make an escrow account.
Hmm.
We gotta have a year of insurance already built in. We gotta have 3 or 4 months of real estate taxes so we can start your escrow fund. And then the title company gets paid, and then doc stamps, and then there's a lot of they might that's not money that's going to us. And I think that's a huge misconception that, oh, we're charging $7,000 for
Hmm.
closing costs, when in reality, a good portion of it is going to set up your escrow account. And then you have, it's kind of like when you buy a car, you have tax, tag, title, fee that aren't part of the normal, paying down of the actual car loan. It's just transaction costs. That's exactly what closing costs are.
Yeah. Now I'll be real with you. When it came
Be
to
real.
closing costs, I forgot about the escrow cost, and I was just sitting here like, oh yeah, you guys charged them $7,500. No, yeah, but that's legit. Like they have to start the escrow account, put all the money in there. So that makes a lot of sense. All right, so let's wrap it up on this question here. As we kind of went a little over, but what are your predictions going forward as far as what's going to happen with the housing market? What do you think is going to happen with COVID-19? And once again, I know you're not Oracle. You don't have a magic 8 ball there with you. But from your expertise, like from your experience so far with the lockdowns, with everything that's been happening, the election coming up, because good God, we have to factor that in as well. So, with all that involved, what do you think is going to happen over the next like 6 months to 12 months?
So I believe all the way up through the election, we're going to have low interest rates. Real estate is going to continue to rise. I think it will slow down, but we're moving into the summer months. Whenever you hit the summer months, parents are trying to purchase so they can be in the house before August, where school starts. So I think we're gonna be hot all the way to August, September, and then we're gonna slow down as far as what real estate is going to do and what the economy is going to do. I think that the feds are still going to continue to pump money into the economy,
Oh yeah.
just just to kind of
That's all they have.
um,
That's the only tool they have. The only thing is that because interest rates are so low now, there isn't much of anything else they could do.
right. So they're just going to keep. That's all they can do is keep pumping money. And the reason why real estate has gone up so much and everything else has gone up and the cost of living has gone up is because of inflation. And
Hmm.
inflation occurs when they're artificially putting money into the economy, and now we got more money. And yeah, it's just, I don't
Hmm.
want to go on a 5 minute, 10-minute
Yeah.
explanation of kind of how everything. I was trying to figure out how I can make this short and sweet, but there's just not any way I can make it sweet. But
Yeah.
I think that real estate will stay okay for the next couple of months. Next year, this time I think it's going to be different. But
Yeah. No, I agree with
what
you. I think next year we're going to see. I think because the market took such a sharp dive, it's going to have a sharp recovery, and we're going to start seeing, once the news of like a herd immunity starts going through, or a vaccine gets developed, we're going to start seeing the market take a shift. A lot of the stuff that's happening right now is just speculation. You have a lot of investors out there who are freaking out, and unfortunately, a lot of these investors are tied up with the real estate market, and this affects a lot of what happens in the real estate market. So, if we see any dips or dives or increases, it's because either they're freaking out or they're super excited about what's going on. So I think in next year, at the same time next year, we'll have a completely different market. We'll be firing on all cylinders, and we should be good. But for right now, I think most people should just stay safe, try to keep their employment, and like I said, the whole, if you're planning to buy a house, in the next 6 months, 6 months or to a year, now is the time to start actually planning that. You got to save that 20%. You got to get that, $7,500 or that 2 to 4% for closing costs. And start shopping around, start getting your idea, start educating yourself, start learning some things. Subscribe to my video so you can stay up to date and learn more. And yeah, and then so I think we should be good. But right now, it's just there's a lot of unknowns in the air right now. So
I'm actually really surprised that there hasn't been a massive call for people to start selling off their properties. I actually thought that more people were going to start selling their properties because of the uncertainty, because they didn't know what the market was going to do, because they possibly lost their jobs, in order to cash out on some of that equity. That's what I thought was going to happen. And then it'll go from a seller's market to a buyer's market. That's honestly what I thought would have happened throughout this uh, COVID-19, and kind of what I was hoping.
yeah, I mean, that's definitely another video we can talk about. Is I have my own theories about that as well, but we'll wrap it up on that. Mr. Batista, I appreciate your
Yes, sir.
time, and go ahead, plug yourself so you can let people know where they can find you.
Yeah, you can find me on Facebook, Evan Batista, or you can just reach out directly to me. It's 407-619-6955. That's my personal line, and I'm sure Mike will go ahead and tag me in the video, so you guys can just click right there and come directly to my page.
And what's the company you work for?
I work for the mortgage firm
Gotcha.
right here
Uh,
in Altamont.
yeah, Altamont, Central Florida area, but you do service people from
All of
around the
Florida,
country. Well, all over the country as well, right?
not all the country.
Well, if
Just
someone's like deciding to move down here, they can
we,
come
we
get you.
we we do Georgia and a couple other states,
Mhm.
Tennessee and a couple other states, but I like to stick to Florida.
Gotcha. All right. Well, Evan, I appreciate your time, sir. Thank you so much. And if you guys have any other questions, go ahead and leave them in the comments down below. If you have a question for Evan, go ahead and leave it down there, and I will go ahead and have him back on the show so we can sit there and talk about it and discuss any ideas or any concerns, or things that things you want to talk about. But other than that, make sure you hit that like button, subscribe, and I'll see you guys in the next video.
Thanks, Mike.